Good evening. I'm Albert Carnesale, the Dean of the John F. Kennedy School of Government, and it's my privilege to welcome you, all of you here this evening. This evening, we celebrate the inaugural Malcolm Weiner Lecture on International Political Economy. Malcolm Weiner has been a longtime friend of mine, of previous deans of the Kennedy School, but most importantly, of the John F. Kennedy School of Government, and is the benefactor of the Malcolm Weiner Lecture in International Political Economy. He's also helped us greatly with advice, counsel, and with other important institutions within this school, such as the Malcolm Weiner Center for Social Policy and Malcolm Weiner professorships. I was talking to Malcolm earlier this evening and asked him, what is it that inspired him to endow this lecture series that we celebrate tonight, the first evening? And Malcolm told me, he said, well, when he was an undergraduate here at the college, he remembered the Godkin lectures. And he had remembered in particular two of the lecturers, names that some of you might recognize. C.P. Snow was one of them, and Adlai Stevenson was another, and hoped that perhaps we might have a series of lectures of that caliber, but in the important questions of international political economy. This lecture series commemorates his scholarship in that field, his interest in international financial matters, and is the first of the Malcolm Weiner lecture series. So before we turn to our speaker tonight, I would like to recognize Malcolm. If you would please say hello to Malcolm Weiner. And to Mrs. Weiner, Carolyn. The institution that tonight's speaker represents, the Deutsches Bundesbank, has been called the world's most powerful bank. It played a strong role in rebuilding West Germany's post-war economy and helped forge speedy unification with the former East Germany. Now, the Bundesbank, the keeper of the powerful Deutschmark, may well hold the key to the future of the European community. Tonight's speaker, the president of the Bundesbank, has played a critical role in this most influential of institutions for over 40 years. Helmut Schlesinger began his career at the IFO Institute for Economic Research in Munich, having received an economics degree from the University of Munich, and having written a doctoral thesis on, and I quote, economic efficiency control in the civil service, close quote, a relevant subject to those of us here at the Kennedy School. Indeed, like many Kennedy School faculty members, he was trained as an economist and specializes in public policy. He should certainly feel at home here. In 1952, he went to work at the Bank Deutsche Länder, which was the predecessor of the modern-day Deutsche Bundesbank. The Bundesbank was founded in 1957. Its mission is to maintain the value of the Deutschmark by regulating the amount of money in circulation and the credit supplied to the economy. This is the mission that our speaker has firmly pursued throughout his career. In 1964, Dr. Schlesinger became head of the Research and Statistics Department, and in 1972, he joined the Bundesbank's governing board. By 1980, he had risen to be deputy president, and in August of 1991, he assumed the presidency. Since then, he has had to face some rather formidable challenges. Restructuring the Bundesbank Council to take into account the new states from the East, holding down inflation in the wake of German unification, balancing the Bundesbank's monetary policy with bonds fiscal policy, and moving toward European economic union, all in the face of a worldwide recession. He's known to climb 13 flights of steps to his office each day, and to adhere strictly to the mission of the Bundesbank. Indeed, our speaker has been called the Iron Man of international money. Presiding over the Bundesbank during these tumultuous times requires a man of at least iron, if not steel. So please join me in welcoming the first Malcolm Wiener Lecturer on International Political Economy, the President of the Deutsche Bundesbank, Professor Dr. Helmut Schlesinger.
Honorable Dean, respectability, as we say in a German university, Mr. and Mrs. Wiener, ladies and gentlemen, it is a particular privilege for me and an honor to be able today to speak to you as starting the Malcolm Wiener Lecture on international economic policy. It is also an honor for me to do it here in this forum. As a European central banker, I also much appreciate, not least, the great interest you take both in the current very topical issue of German monetary policy and monetary integration here in Europe at the same time. That interest can only be to our benefit. For Harvard and the scientists here searching and teaching here, they have a major share on the development of economic theory as it stands today. Also, I never had an opportunity to be in such a happy position as those countrymen of mine which are coming here and to study here. I had for a long time very close relationships to your university's Professor Emeritus Gottfried Haberler, in which I am in contact up till today. Harvard's reputation is also based on the fact that it can look back on a long tradition of research on problems of direct relevance to policymakers, and this school in particular. It is therefore my particular pleasure for me to have been invited by Professor Graham Allison for a long time to come at any way to this institution. At the Bundesbank, we have recently paid great attention, above all, to studies in particular of particular interest for us on the question of the independence of a central bank. As far as I know, the significance of a central bank independence for the success for its anti-inflationary policy has recently returned to prominence in public debate here in the United States, and one can look back to the outcome of the studies of Alesina and Summers, which they published 2 years ago on this subject. And Lawrence Summers can now use this insight in the problem in the position which he has. In Europe, this issue was the subject of a lively debate, above all, in the run-up to the Maastricht Treaty. In the absence of the fact that not all central banks in Europe have an independent state, it was necessary to formulate a statute for a future European central bank as an independent central bank. And at the same time, the treaty is asking giving full independence to all national central banks. Various countries are already considering specific measures to meet the requirement for this monetary integration process. The soonest possible establishment of independent central banks in the other EC member states is certainly an effective way of strengthening the credibility of an anti-inflationary policy resolved of all parties involved. Just how necessary this is, it has been highlighted, I think, during the crisis which we have had in the European monetary system in autumn last year. What is just as important as the creation of the prerequisite for a successful monetary policy is the institutional side, on the one hand, and the question of the monetary management on the other side. Both of our own experience and scientific findings on the other have underlined our conviction that monetary targeting geared to the growth of overall monetary production potential, such as we use in the Bundesbank, is a useful guide for a common monetary policy in Europe. An argument against this may be that similar monetary targeted, which we have had in our country, were not as successful in a number of other countries which tried to have it. In many cases, this owed something to the factors which have their roots in structural deficits of these economies. I would now like to attempt to justify by briefly outlining the basic elements of the monetary policy concept used in Germany, and by discussing our latest experience in the stormy time after the German unification, before I try to focus some problems on the way to a European monetary integration. Legislation commits the German monetary policy makers clearly, as it has been said by the Dean, to the priority goal of price stability. This arrangement reflects the far-reaching stability policy consensus which we have in our country among practically all groups of our population after the painful experience of two hyperinflations. The fact that the trend in money stock plays a key role in this context is probably not subject to any serious doubt today in many countries after Franco Modigliani has opened the annual assembly of the famous American Economic Association 15 years ago by saying, "We all are monetarists." Also, Professor Modigliani certainly did not mean it to be taken quite so literally and seriously. The core of this statement, namely that there is a close link between the trend in money stock and that in prices, at least over the longer run, was indisputable then, and it is also up till today. This has meanwhile been confirmed by a great number of empirical studies, which I am mentioning in the written form of my statement. What is a far less common belief, however, is the answer to the question as to the short-term effects of monetary policy measures. While the existing time lags in monetary policy is not subject to any dispute, the length of these lags and the resulting danger of monetary policy measures only becoming effective when they are no more necessary or even negative with its effects is one point which one has always to study. This once more has become clear from the long time lag between the monetary policy turnaround in your country in '90 and the actual onset of a visible upward tendency in the US economy in '92 and now. German monetary policymakers have drawn the conclusion from their experience, namely not to make ambitious fine-tuning as their goal, but rather to create general monetary fundamentals which ensure both price stability and adequate growth for the medium term. In other words, German monetary policy is not understood primarily as an anti-cyclical policy, but it is geared rather more the longer-term variables such as growth of the overall economic production potential. it thereby quasi-automatically triggers a disciplining adjustment constraint. If overall demand is too high in the economy, then we have a refraining effect. And if the contrary is the case, then the growth of money supply oriented on the production capacity, not the actual production, is giving a certain stimulus. In spite of the repeated necessity of adjustments, the Bundesbank has adhered to this concept of potential-oriented monetary targeting since 2 decades. This was by no means an easy matter at all times. For instance, the introduction of the D-Mark in the former GDR in summer 90 and the subsequent political unification of the 2 parts of Germany brought a fundamental change in the conditions under which German monetary policy had to operate compared with the past. Whereas German monetary policy makers had been able until that time to rely on the stability of the key underlying macroeconomic relationships, the extension of the D-Mark area placed this in doubt overnight. Against this background, it could well have been deemed appropriate to change over to other monetary management concepts. At the time, for instance, it was recommended that the Bundesbank should increase its orientation on a policy of interest rate changes. In view of the significant structural changes in the real economy, however, we did not regard this as an effective solution for resulting problems. Literature too told us that in the event of a primary real economic distortion, the indicator quality of interest rates tends to be inferior to monetary aggregates. This was why we retained the concept of potentially oriented monetary management with monetary targets announced to the public in advance, also for the unified Germany. It was clear from the very outset, however, that this would be associated with major difficulties because the information available on the major developments in the new Länder was very vague. Important questions were: what output can we expect in transforming the communistic-orientated economy into a market economy? And yeah, we were too optimistic in this sense. Another question was, what does it mean for increasing the money supply according to a given political exchange rate between the East Mark and the West Mark? And the outcome was then the increase of the money stock was too large. And how would the population behave if they have a new money in hand? Would there be any saving? Fortunately, it was and it is, and so on. It soon came to light that the first all-German monetary target for 91 had to be revised downward because of this too much extension of money supply in the monetary, in the start of the monetary union with East Germany. And last year, the Bundesbank was confronted with serious problems when the strict monetary target was strongly overdone. A number of factors were responsible for this development. Demand for credit was very strong in our country and is even strong up till now. And high market interest rates at that time had been reduced in their effect, working for the economy through a high amount of interest rate subsidies, giving practically to most of the investors in East Germany. And so we come to an overshooting of our monetary target, nearly twice as high as we thought we should have it. Many of these problems were associated with the unification of Germany. And they would have been enough to make all national forces concentrate on coping with them. What was involved was ultimately to by no means simple task of transforming a former communistic ruled country, a region and a population not smaller, a little bit bigger than the ex-Czechoslovakian Republic, to transform it into a market-orientated country without foreign aid, only with the aid of West Germany. But the task confronting the Germans was and still is much more complicated, because at the same time they have to integrate unified Germany into the common market, and they have to achieve these under conditions which are rather difficult, also as far as the world economic situation in this time has been concerned. Let me explain this a little bit more in detail. As a result of the unification, the total public sector deficit on budget and in one way or the other off budget, we have those managements at the moment in Germany as well. This total budget climbed to a magnitude of 6% of GDP, compared with less than 1% in '89, it means before the unification. To this were added excessive wage and salary increments in '91 and '92. In order to be effective, monetary policy makers consequently had to tighten the reins somewhat. In the essence, however, it has fortunately proved possible to bring about a basic change in thinking in our economy in the course of this year. This is true in respect to wages, and it will be true for the public deficits, because there is now an agreed program for bringing it down to a large extent beginning in '95. And the downturn in business activity in our own country has and is now limiting the scope for price increases also on the demand side in West Germany. While things of inflationary tendencies are being diminished, and while the international markets are rewarding this in a form of a rather stable D-mark exchange rate over all that period, and declining long-term interest rates in the German capital market, major European partner countries are calling for more rapid and more marked interest rate cuts in Germany. This is where the other side to the coin becomes visible. The consequence, Germany's domestic problems were having also unavoidable for our neighboring countries, especially those in the common market. Viewed against the background of a weak business activity and high unemployment in these countries, these complaints were and are understandably. But two facts are overlooked in this context. German interest rates have already fallen perceptibly. This holds true above all for interest rates in the medium and long-term market, in which we have now a rate of 6.5% as far as government bonds are concerned. And these markets are important for investment decisions in our country in particular. And to mention one point, at the end of the scale of maturities, as far as 30-year bonds are concerned, interest rates in Germany are no more higher than in the United States during the last weeks. Taking account of the current rate of inflation in Germany, it is more than 4%. Longer-term real interest rates are actually low, and on historical standards in our country, they are extremely low. On the other hand, German interest rates in the capital market have now reached a level at which the markets could assume that there is a risk of a setback. On account of its traditional longer-term financing pattern, this would have a harsher impact on the German economy than could be offset by a policy of enforced interest rate cuts in the short end of the market. We are therefore going on very carefully with further downward steps. For more than 4/5 of all bank credits in Germany are accounted for long-term borrowing, and the major proportion of that is given on a fixed interest rate basis. In principle, this is a special strength of the German financial system, which has its counterpart in the high share of long-term savings, a form of capital formation which is acceptable for savers, for investors, only if they actually have long-term confidence in the value of the money. What is therefore demanded of German monetary policy makers is not to create any negative expectations as far as the anti-inflationary policy guidance is concerned. In order to make these complaints of our European partner countries about the temporary high level of short-term interest rates, understandably, we tried what we could do to bring down short-term rates as well. They are now down to a margin between 7.5% and 8.1%, compared with the neighborhood of 10% August last year. I have to go now into the constraints of the European monetary system under those conditions. This system, the EMS, belongs for all member countries of the common market, but what is really important, this is the ERM, that part which is now important for 10 of 12 states, in which exchange rates are fixed but adjustable if necessary. I mean, the problem in that system, which is and which has created the difficulties coming from our interest rate relations in the past. Or let me say this in another way. In a system of floating currencies and vis-a-vis floating currencies as the US dollar and the yen, between the D-mark and the dollar, interest rate relationships are not so important because exchange rate movements can work to bring both movements into a balance. In the ERM, by contrast, in the system of fixed exchange rates, the partner currencies must orientate themselves relatively closely to the short-term interest rate level in the anchor currency, and this is the D-mark. The weaker currencies in particular are more prone to inflationary expectations and must therefore offer higher interest rates than for the D-mark to avoid coming under the pressure as far as the exchange rate is concerned. But if the tensions become too strong, only a devaluation of one of these currencies or these currencies, weak currencies, can be of a help, and this happened after some turmoil in the markets in between September 92 and February 93. This brings me to the dual role played by the D-mark in this system. In principle, a monetary policy geared consistently to stability is necessary not only on national grounds, but also with a view of the process of European integration. At the same time, however, national monetary policy makers must give as much consideration to the needs for their partner countries as is necessary to prevent the resulting policy constraints from becoming unbearable for these countries. A solution to this conflict could be at the end and should be a European monetary union. The arrangement adopted in Maastricht, this is the treaty which the governments have signed, and 10 national parliaments have now ratified. This treaty is the first extension, important extension, of the Treaty of Rome, which has created the European Community in 1957. These arrangements adopted in Maastricht are indeed aimed at the transition to a European monetary union of those countries which meet the criteria set by the end of the decade. At the latest, it means in 1999. Should the majority of member states being able to meet this entrance criteria earlier, a majority in 1997, then one could start a European monetary union also at this time, but it is not very likely. In many quarters, the loss of credibility of the EMS parities after the events of last year has been considered to be a setback of the whole movement to a monetary union. They had relied on the fixed exchange rates vis-à-vis the D-mark being as a mean to gain credibility and reputation for all countries involved. As we have seen, such exchange rate packing can indeed support the building up of a certain stock of confidence, but only to the extent that the resulting stabilization constraints are fully met internally. One cannot stabilize a national currency only on the basis of pressures from outside. Especially it is necessary to have similar movements in wage and fiscal policies. These interrelationships have been forgotten in the last few years. Indeed, there was an illusion created that we are already living in, let me say, a de facto monetary union. Both the EMS and the process of European integration have been considered as someone which must not necessarily change before we are going into the monetary union. But we have seen that the most important precondition for the movement into a monetary union, it means having the necessary convergence between the economic developments of the different countries, that they have not been given. The Treaty of Maastricht is formulating so-called entrance criteria which the countries have to fulfill. It means criteria about the degree of inflation, about the magnitude of the deficit of the government sector, and having stable currencies, stable exchange rates for, let me say, at least 2 years. The hard currency countries in the EMS, they are responsible for setting the standard of price stability. Others which want to come in cannot go over 1.5% higher than the rate of inflation of the most stable currencies. On an account of the D-mark anchor function, this holds particularly true for the importance of German monetary policy for the community as such. The future European Central Bank will be dependent on this start-up capital, starting on a basis of credibility. The Maastricht Treaty and, in particular, the statute of the European Central Bank had created, by my opinion, favorable prerequisites to come to this monetary union and to be effective as far as a European monetary policy is concerned. The goal of this monetary policy which is prescribed in the treaty is price stability. And this goal, for instance, has been expressly anchored in the statute as the main function of this bank. And the independence of the European Central Bank from instructions from the national governments as well of the institutions of the common market are another point of guarantee to be able to have such a policy. In addition, the ban on lending to public authorities through the European Central Bank and the national central banks, which are practically then their branches, is also very important. The European Central Bank will not, however, be able to draw on an anti-inflationary policy reputation of its own, because it has to start from zero. And a reputation which can be earned in a lengthy process of an proven anti-inflationary process is not existing. So one tries to transfer the confidence to the D-Mark and to the Bundesbank and to other stability-orientated countries into the new European monetary system, the European and the European currency, by formulating the new European Central Bank quasi in the same way as the Bundesbank is formulated. A self-binding commitment of the European Central Bank to medium-term orientated monetary targeting modeled in Germany could also be helpful in this respect. I have to add, especially for the academics here, that certainly this is a rather simple concept, but it has a number of advantages, especially for bringing together regions which have a different degree of development between the north of Europe, so to speak, and the south of Europe, and in which one has to try to create a history of its own for the newly created European Central Bank. But the move towards a larger monetary union will always entail some risks. There are a number of fundamental economic problems that lie outside the pure monetary sphere. It has been helpful that Martin Feldstein has emphasized these problems on a very logical basis. In my view, however, all those in favor of the political goal, and this is the primary goal, of a unified Western Europe may nevertheless be prepared to take this step and to take over the risks which are involved. Credible endeavors to achieve stability are of key significance not only for the further progress of monetary integration in Western Europe, this would be also of a crucial importance for the reforming states in Central and Eastern Europe. But certainly the problems are much more difficult. It is undisputable that in the medium term, a monetary policy geared on the money stock would be of help for these countries. But taking into account the existing situation in these countries, one cannot give this advice at the moment. Macroeconomic stabilization in the reforming states of Central and Eastern Europe is such a comprehensive task that monetary policy means alone are incapable to cope with all these problems. In the long run, only an overlapping, coordinated program of both reforms and stabilization efforts can promise a success. This includes not only fundamental economic reforms, such as the liberalization of prices, the decentralization of entrepreneurial decision-making, and the demonopolizing of the enterprise sector, but also macroeconomic stabilization measures such as reducing your public sector deficits and having a moderation as far as wages are concerned. Irrespective thereof, however, a monetary policy geared to the money stock in the early stages of the reform process, one will find quite a number of technical difficulties. For instance, one doesn't have really experiences about the demand habits of the population, how they use their money in hand, if they are prepared to save, if they have a high degree of circulation, etc. What is often proposed as an alternative monetary policy strategy under such circumstances is the pegging of the national currency to a hard currency. It is undisputable that such a linkage of monetary policy has advantages for those countries. It is easy to apply. It is easy to say we want to keep our exchange rate stable to a strong currency. And it is easy to understand. But it is very difficult to exercise it. And presumably, even this cannot be suggested in the first stages of the development of these countries. So, in other words, they have the difficulty to find the right exchange rate at the beginning, and then they are confronted with the fact that they must change their exchange rate to keep competition with other countries on the one hand. On the other hand, that if they are changing their exchange rate very, very often, they have never a chance to come to a stabilization of its internal price level. So one of the solutions which one can find, and which we, the Bundesbank, are also advising to those smaller countries, by the way, in Eastern Europe, which are getting our technical help, is that one should try to have a pegging, but so to speak on a rather flexible basis. Some of these countries wanted to peg it to the AQ. The AQ is the European currency unit. The AQ is the average, so to speak, as far as the exchange rate movement is concerned, of all national currencies in the community. So it is a basket of currencies. It is not one currency. And those countries in Europe, especially the Scandinavian countries, which did it for a while, find that it's technically very complicated to keep the stability of their own currency vis-a-vis this basket of currencies, because for intervention, etc., they need some national currencies. It means the D-mark or the dollar. So what one could more advise to these countries is that if they are choosing another stable currency, they can use those currencies which are most important as far as their foreign trade is concerned, usually in a different weight. It may be the D-mark and the dollar. What is demanded for monetary policy makers in this context and in these countries is the willingness to take the monetary policy actions which they see. And they should be guided not only by the political questions of today. They should come into a situation in which they can have a longer-term view. The independence of the central bank strengthens the anti-inflationary policy backbone in the economy and in the currency. This is our, bring it to a short version, our own experience for the long period which the Dean has prescribed. A German philosopher has said, Geld ist gefrorene Freiheit. It means a stable money gives you freedom. And this is what we should have as the final target of this policy. Thank you for your audience.
Thank you, Dr. Schlesinger. Dr. Schlesinger is willing to take some questions. We have two microphones, one here and one here. I would appreciate if those of you that have questions would come to the microphone and identify yourself and ask a question. But I'll ask the first question, which is always, as it gives people an opportunity to come forward. And this is the obvious question. We've talked some earlier today, is observations on, we always like to ask visitors who are well informed but also have some degree of objectivity to look at what we're doing in the United States. And as you look at the economic package that our president has prescribed and sent to Congress, not only but what we're saying, but what we're doing. Appreciate any comments you might have about the extent to which they appear to be in the right direction or in the wrong direction from your perspective.
Should I start with this answer?
Well, as far as the package of your new president is concerned, I should be able to give such a well-phrased answer as Alan Greenspan has given, because I read that in one of these congressional committees, he was asked, I don't know if he has first started with saying, is this the consequence of the dinner which you have had on the side of Mrs. Clinton? But then he has told him, you have supported the president. And then Mr. Greenspan was saying, well, I said, it is based on a good analysis, and it is very detailed as far as the program is concerned. And then he has a third criterion, but I have never supported it. So this is the way in which central bankers sometimes have to answer. Not being able for such an elusive English vocabulary, I must say, first, you are now, after a long period, a longer period as usual, you are now in an upward movement. And I think this is a very satisfying result. And this movement is going on without inflationary tendencies up till now. It's going on with a moderate increase of money supply as far as M2, M3 is concerned, not so much M1. And I think the aspects are rather good for a continuation. When I started my studies in the IFA Institute, which was an institute for cyclical research, so to speak, the boss told us always, the economy is either going up or going down. And since this 40 years, he was always right, I must say. So, I mean, it's going up. And I hope for a longer period. And then, for someone as a central banker, as I, then there is another danger to be kept in mind, that the dynamics are not getting too strong. I mean, the problems which you have had before with the recession, in the financial sector, etc., were the consequences of a too strong development in the second half of the 80s. And this is something which one should try to avoid. Too much dynamics, too much growth rates anywhere more than 10% usually are of a problem. maybe prices, maybe wages, maybe whatsoever. So I think you, at the moment and for the next time, you are in a rather satisfying situation. And when you do not have, up till now, strong reactions in the employment situation, well, as most of the students know here certainly, employment is a lagging indicator. First, you have strong increases of productivity on the existing level of employment. And now, presumably, you came into the phase in which employment is growing, and the new president may have good results 1 year later.
Right here. My question also had to do with this country. You termed the growth in M2.
Could you identify yourself, please?
My name is George Fisher. I'm not associated with the school. You sounded sanguine on the growth of M2 and M3 in this country, but a lot of people think they're just dead in the water. You know, M2 is down this year. It's not even stable. Now, and even M1, which had been, 15% for some time, has tailed off dramatically in recent months. Now, coupled with the conspicuous lack of employment growth in recent years, the monetary aggregates again trailing off here, a lot of people think that maybe our Fed should be easing somewhere in here. And I don't know what result that would have in the bond markets at this point, but I wonder if you'd comment on that. How do you, maintain growth of, say, 3 or 4% in real GDP without any growth in M2 or M3 at all?
Well, this is certainly a temporary effect. And if you look on M1, which is growing strongly and has been growing strongly, it's certainly a consequence of the yield curve. I mean, there is not much loss of interest rate revenues if you go very liquid. This is also a situation which usually is not going on very long to my experience. Please, I am not an expert on the monetary questions of this particular type in your country. The other point is that even the short-term interest rates went down strongly. The long-term interest rates were not coming down, not only so strongly, usually one cannot expect that, but taking for long-term government bonds a rate of 6% on a basis of inflation of 2% or a little bit more. This is not really a very low situation. And why is it so? Well, I can only go back to the explanations which I got. Because the markets have always a long-term memory, and the long-term memory in the United States may be different for the future, but for the moment, where a relatively high degree of inflation since the end of the 60s. And so long-term engagements have to be paid relatively well as far as the interest is concerned. Presumably this was also one of the factors, the way to this rate, long-term rate, why investment have not responded very strongly in 91 and 92. So, but this is not only impressions which I am getting from the discussions with my colleagues.
For those of you that are not macroeconomists, we'll have a primer tomorrow here at the Kennedy School. I will recall, some of you may recall Dick Dorman, former member of our faculty, came back a few years after he had been a budget director and gave a talk in this very room one evening and said, I've learned a lot about macroeconomics. It relates to this point. He said, first of all, for M1, if M1 goes up, it's good for the economy in the short term, but bad in the long term. Or else it's bad in the short term, but good in the long term. Or it may be good in the short term and good in the long term, or bad in the short term and bad in the long term, and depending on which one you prefer, I'll call the relevant economist and get him to explain why. So this has always been a problem we have faced. Yes.
My name's Muin Bartley. I'm a first-year student at the Kennedy School, doing a master's in public policy. I was wondering if you could give us some advice. I'm from Pakistan, and our economy we've just gone into a phase of deregulation and liberalization 2 years ago. And our state bank, coming in from a situation where it was just managing 5 nationalized banks, now has to regulate about 500 different national as well as private banks and finance companies and different funds, and also has to regulate a rapidly growing stock market, which has tripled in the past 2 years in its capitalization. I was wondering if you could give us some hints or some pointers as to what should we look out for.
First, I am not a regulator. The Bundesbank is not regulating.
That's what we're trying to get out of as well. I mean, we're trying to get out of being a central economy.
Yeah, and personally, but not only for personal grounds, this is another aspect of the whole subject. Also, on the basis of some convictions, I think it is good, it's my personal opinion, it is good if a central bank is not directly involved in regulating. Because regulating, this is the power which the government uses. And an independent body like a central bank, constructed like the Bundesbank, is not the government. So, but this is more a point of a practice and philosophy. Well, you have quite a number of regulations, and certainly you have more than we have. There is one point involved which I always are asking my American colleagues. A German economist is usually a market economist and a liberal economist. And he finds that regulations which one is giving into economy must be considered from 2 sides. On the one side, it is clear that one needs some order as far as banking and financial markets exchanges are concerned. This is clear. On the other hand, the question is how to involve market forces into the whole process. Isn't it the consequence that one is limiting market forces and consequences of market forces, that one has to go to regulation? What I have in mind is, if there is the feeling that no bank in a banking system can go bankrupt, if there is a feeling whatever the mistakes of managers in banks are, there is a state finance deposit insurance. There may be managers who make mistakes under those conditions. In other words, it is the question of the order of the economy. If one has enough market sanctions in the system, or if one has taken out, without thinking like that, those sanctions out of it, and then if there is no market sanction, if there is no tendency for a real bankrupt, if there is no clear situation that the managers are losing the job, and that the owners of the bank or whatever the institution is losing its property, then you need more regulations, as if you give this to the market. But to have the right balance between both, it's much more complicated, as I have said here. I'm quite aware of that.
Thank you.
My name is Stephanie Flanders. I'm a first-year Master of Public Administration at the Kennedy School. I have an unfair counterfactual to ask you, but it's been ironic that the intervention the Bundesbank's intervention to support the sterling, franc, and other currencies in the RM has itself added considerably to German monetary growth. If the Bundesbank in September had been able to anticipate how much intervention would be necessary, do you think you would have looked any more favorably on further interest rate cuts to avoid it?
Is your memory that we have not intervened?
No, that you have that you have had considerable intervention in order to support the franc and the certain failure with the sterling, but certainly a large amounts of money. Counterfactuals are very popular in Britain at the moment.
And what should we have done? What was your alternative?
Well, if you had been able to foresee that that much intervention would be necessary, do you think that it would have, in terms of the Bundesbank's own desire to maintain stability of German monetary growth, would that end have been better served by an interest rate cut rather than the interventions which followed?
Ah, you mean it would have been better to lower interest rates?
Rather than have to...
Yeah. Well, yeah, this is the conflict in which one is, yeah, in the system. Yeah. And the question is, what side is the most important? Well, and the most important for the central bank, it's their own currency. I mean, there can no doubt about. The second problem is what happens for the others. Yeah. One has to have it in mind. No, but to be very earnest here. I tell you, in the Central Bank Council, we are discussing about these problems more than about the domestically necessary measures. They are usually rather clear what one has to do and not. I hope so. Yeah, but the judgment about the consequences internationally is much more complicated. But there would not have been a necessity of such type of crisis if one had kept the rules of the EMS. And the rules are, if a currency is coming under constraint, first, there are possibilities of interventions. Second, change the interest rate, go up with the interest rate for a weaker currency. Yeah. And third, ask for a realignment. And this is what not has happened. Yeah, it has not been asked for a realignment, especially those from this side which have been under pressure. Those who have been asked for a realignment was the Bundesbank. We went to our government and the government asked for a realignment when it happened for the Italian lira. So what one has missed was the right time for a realignment, which is according to the rules of the EMS. Going out of the EMS is not written in the EMS.
Yes, my name is Robert Chu. I'm a first-year student here at the Kennedy School. You mentioned earlier that the primary goal of monetary union is political and not economic. And you also cited Martin Feldstein's argument, which basically is that it is not in the economic self-interest of European countries to proceed with monetary union. And as you know, there are many that would argue, particularly within Germany, that it is not in Germany's economic self-interest to give up the Deutschmark and its de facto leadership in the European monetary system. So in this regard, I'd like to ask you two questions. One is, how do you respond to the argument, to that question, that it is not in Germany's economic self-interest to proceed with monetary union? And secondly, assuming that either the Danes or the British reject Maastricht, and perhaps even the Germans do not ratify Maastricht, is the German political commitment such that it will proceed with a partial monetary union, perhaps with France and the Benelux countries, if the rest of Europe does not follow behind them?
The German parliaments, Bundestag and Bundesrat, have ratified. The Bundesrat, that's the regional chamber, with 100%, and the Bundestag with 95% of votes. So as far as the decision makers are concerned in Germany and the legislator, there is a clear support for the Treaty of Maastricht. There are discussions in the country about the subject, before this decision and after. It is mainly founded on the basis, is the monetary union economically profitable for the Federal Republic or not? Here I would say, if we have stable conditions in Europe, as we can have it in the EMS, then the integration process, as far as the transactions of goods and services, of man and of knowledge are concerned, there is no real need for one currency. Economically, this is Feldstein's argument, together with all the arguments what could happen with a common currency. But as I told you, this target of the Treaty of Maastricht is the European Union. This is the name of the treaty, European Union. Unfortunately, at this stage, one has only correctly and in deep formulated the monetary union, and one has left open to rather vague formulations other parts of a political union. It means foreign policy, it means defense policy, it means unification of the juridical system of the countries, etc., and it was postponed, so to speak, for 96 to continue on this subject. So it is primarily a political question if we want to have a European Union, which is not a European state, which is not necessarily a federal state, which may be a federation, but this is the political target. And as far as Germany is concerned, and the policymakers of both the most important parties in our country, it is our attitude since Adenauer that we want to be a part of Europe politically, that we do not want to be alone. We have our own history, and this history, if history is telling us anything, it tells us that we should be combined with our neighboring countries. Insofar, the political target is overwhelming. But together with that, a European monetary union, if it functions, which is undisputable that one cannot have any other risk, if it functions, will presumably even give additional support to the economic integration in Europe, which is the target of the common market, and as it is called now since the beginning of this year, the internal market in Europe.
Is it not hard, though, to contemplate giving up the Deutschmark and, as president of the Bundesbank, submerging your power to a European central bank where Germany will only be one of many players?
Well, there is a number of discussion about this point. This is quite clear. And it is not only the question of the mark, to give up the mark, it's also the question to give up the pound, to give up the guilder, etc. There are some currencies which one can give up, perhaps. My dear daughter, she tells you what she has in mind. She is living in Greece, so.
Oh, okay. I thought you were going to name them.
This is one is certainly a dispute for a longer period. Excuse me.
That's the perfect transition. My name is Dimitris Vretakos. I'm from Greece. I am a student here graduating. I'm going back to...
If you are long enough here, you can solve the problem. You are coming back.
Actually, I have also a question for the longer term. My question is the following. You said that it will help in integration, and earlier also you referred to countries of the South, and I would like to ask you, what will be the impact of a stringent, if not stringent, reasonable and tight monetary policy of a central European bank to the less developed southern nations, although they are receiving a lot of structural funds which are well spent and their incomes are going up. I would like to ask you what if there will be the phenomenon that we have here in the States, some states to have better economies and some others to have worse. That's one. And if there is a negative impact in these states on investment, assuming that capital and people flow as freely as here, what implications will have in new members, which considerably some of them will be poorer also?
Yeah. Well, as far as your lovely country is concerned, well, yeah, I said this to one of your Greek journalists. It's a misunderstanding that one must be a rich country to have a stable currency. That isn't true. You can be a medium-sized, you can be a rather poor country to have a stable currency. That's the question of the political situation and the monetary policy of that country. Take Ireland. Ireland has a stable currency. Rate of inflation in Ireland is 2%. And Ireland is not a richer country than Greece, for instance. So this is a misunderstanding. But what you have in mind is certainly a very big problem. If one is coming into a monetary union, then the exchange rate is no more existing as an instrument of correction a competitive position of a country or than a region. It's no more there, as here. The dollar and dollar prices, they are fixed. Dollar interest rates are the same over the country. And the economic conditions can be different. So the question is how to adapt. One can adapt through, let me say, a necessary, very moderate wage policy in such a country. But if one is doing this not, and if one is practically trying to create an inflation in this region, which is no more an inflation because it's widespread among the whole area, then the pressure coming from the European Central Bank leads to unemployment in this region. So the problem which is really existing, can one avoid such a development? And if not, what to do? Can one bring the national policy into the right direction? Not the monetary policy, it's no more existing, a Greek monetary policy, a German monetary policy. It's only a European monetary policy. But can one have adjustments on the other side? As far as wage policy is concerned, incomes policy is concerned? Or is one creating unemployment and then asking for transfers from the richer countries? That's the point where you have mentioned the richer countries. And then I have to say, one cannot expect the same as between West Germany and East Germany. This is a completely different and unique case that two parts of a nation are coming together, and one has a real incomes level which is 1/3 of the other part, not only of two families, but of two parts. And therefore, the bigger brother has to help the smaller one. One has to help in the community as well, but one cannot expect those magnitudes which I have mentioned. 5% of GDP are transferred from west to east. One has now some programs called, can you help me? Can you help me? Rinke? No.
You mean the structural funds?
No, not structural adjustment. It's another Latin word. Thank you. Social cohesion is.
Those programs are, if you are referring to the second package of the law, will be before 1999, before we become one monetary union.
But one cannot trust, I tell you, if you look at the budget discussions for the Commission. Yeah, one cannot trust that there will be a possibility to come to big magnitudes of transfer payments between one region and the other.
We're running very short time. What we will try to do, perhaps, is if we can hear the three questions, and then you can give an integrated answer. And so let's, if we can keep the, this will be a community answer that will come to these.
Very apt for the European community, of course, integration. Right. My name's Mark Uckert. I'm a special student at the Kennedy School. One of the largest criticisms of the European community is the democratic deficit, whereby the citizens of Europe are very much distanced from the policy making. Yet in your proposals for a European Central Bank, you very carefully laid out that the model that bank would follow would be that of the Bundesbank, an institution which is renowned for many things, but democratic control not being one of them, I think it's fair to say. Now, how do you answer the criticism that in the future of Europe, for the 320 million ordinary people, the workers of Europe and their welfare, their economic welfare, is going to be increasingly controlled by 15 or 20 central bankers who are unelected, unaccountable, and undemocratic?
And if the other two questions are like that, we'll be here till 3 in the morning. Yes.
My question is actually very short because it just resembles what he said. But I was inspired by the question by the way the dean announced you. He said, the president. He paused, and then he continued saying of the Bundesbank. And so it pretty much refers to what he said, so I don't repeat that. Thank you.
I would like to ask you about the last events in the last October, how will affect to the two different Europes with different speeds, the Central Europe and with the same conditions, and the South countries, and also England with a lot of interest in this country, like first foreign direct investor. Thank you.
Once in a discussion like that, someone put forward the question to me, well, you are speaking here about money, about interest rates, about prices, but what about the ethics of money? And the moderator said, well, let us collect some other questions. But nevertheless, I tried to answer it. I do not see a democratic deficit. If a central bank is formulated by a normal law passed through the parliament, in which three things are said. First, what is the task of this institution? Second, what means are available? And third, that they can use these means, which they are given them, without any instruction of the government to reach this target. This is a clear formulation for an autonomy.
Do economic tasks ever change over time, perhaps? If those tasks
well, that's the question for the parliament. The parliament can change the law. The parliament can change the Bundesbank law with a simple majority. Nothing else is necessary. Isn't that any democratic justification? And second, what is really necessary is that we are explaining, as an institution of that type, that we are explaining our policy here all the time, writing monthly reports. I hope you have it here. And explaining our policy wherever we have a chance. Very seldom we have so nice a chance as here in this audience. I hope we are Democrats, and we have the legitimation to act like that. The two different speeds is a question which is a part of the Maastricht Treaty, because those countries which do not fulfill the entry criteria, they cannot be parts of the monetary union, they are outside. And it is also said that then there is a certain council which includes the European Central Bank and the national central banks of those countries which are not in that part of the monetary union. This is set in the treaty. Insofar the discussion, is there any possibility for two speeds, is quite clear. The possibility is given. Another point is, which we have at the moment, that it would be better not to wait so long and to have a monetary union, let me say, between Germany and France, or between Germany and France and the Benelux countries. I think this is practically an idea against the Treaty of Maastricht. If one would do this, frankly speaking, one had to change the Treaty of Maastricht. Yeah, then one must say, well, yeah, we want also have a monetary union outside the Treaty of Maastricht, but in the European community. And it would be something which would exclude other countries of the community which, well, can fulfill the entrance criteria, or even better, as some of these 5 countries which you may have in mind. For instance, Denmark. For instance, Ireland. For instance, any other country here in the year 98, when we may have to make, according to the treaty, the examination who can come and who not.
Let me say a few words of thanks to conclude the evening. First, to Malcolm Weiner for making this series of lectures possible. Secondly, to Graham Allison for chairing the faculty committee that enabled us to have Dr. Schlesinger with us tonight. Third, to those of you that asked the superb questions that they asked. And finally, to Dr. Helmut Schlesinger for getting us off to a wonderful start in this series of lectures. Thank you. There is some water here if you would like. Wonderful. It was a wonderful, fine lecture, and then a wonderful set of questions and answers.
Yeah, very good.
Very nice.
Thank you very much. Good job. How prompt he is. I said 9:30. It's 9:30.
And you said?
Thank you so much. Yes. We can bring you back to
But I'll be back. There's plenty of time.
Yeah.